and we rapid speed down to 2500.
Good point, wherever you reduce speed to 180.
Blackbox.
Hey gang, welcome back. KP's Blackbox. Good to have you. Today we're going to have a conversation, Isaiah and I, my special guest, the right-hand man of the show here, when there's not someone else in that seat. Yep. You get to sit in it. Sit in it, waller in it. So, how you doing?
Doing good. Can't complain. Just telling you, I'm feeling good. So.
Okay. What makes life good?
Makes life good. Recently, just getting in the Holy Word makes life good.
All right. What are you reading?
I started in 1 Corinthians, and now after digging through that for a little bit, I hopped over to John. The Book of Love is what they call it. So.
Okay.
And to be perfectly transparent, I've never, actually, besides, being at GCA or anything, this is, the first time in my life I can say I've actually opened the Bible and sat down and read it intentionally and, actually wrote down notes and getting in it.
Wow. It's interesting. Life throwing you curveballs sometimes will do that, right?
For sure.
Where God can go, hey, have you tried this?
Yeah, it's pretty crazy too, because it's like I was telling you earlier. There's a term where usually a lot of people, when they deal through hard things, they'll go, "Well, I acted this way because somebody did this to me," or this, and that's why I've been trying to stress to myself is not what other people do. It can have cause and effect on the outside, but also looking inward and saying, "What did I do that I could do better, and what can I do here to make other things be better?" And I think a lot of people sometimes when they hear about that, they look at it in the sense of, oh, this person's self-loathing themselves, or oh, they see all these things, when that's really truly not the case. It should be, I did this, let me take responsibility for it, and how can I get better from it, how can I learn from it, and then be better with the people in my life, whether it be immediate family, people that I come in contact with. And that's the kind of stuff that I've been picking up on and feeling like I've been knocking at. So
Nice. That's awesome to hear. Yeah, I think what you're alluding to is a phrase called blame shifting, where instead of taking 100% responsibility for our actions when they're good and bad, it's okay to take 100% responsibility when things are going well.
Yeah, absolutely.
And things are just ticking on all cylinders, and you're feeling great, and you're on a life's high, and you feel really close to God. It's what happens in the trenches.
Yep, absolutely.
Right? That's the salt. That's the resolve. And I'm proud of you for seeing that, realizing that, and grinding through hard times.
Yeah.
Now, that's not our podcast today. That was completely off the cuff. I didn't know we were going to go down that path, but that's cool.
Yeah.
I'm glad we did. And that's words of wisdom. And wisdom, if we talk about the book of Proverbs.
Yeah, that's what I was going to say. I was just telling Jacob, that's probably one of the biggest role models in my life right now is King Solomon. God came to him and asked him, anything that you want, I'll give it to you. And he could ask for riches, and he could ask for all sorts of heinous things. I don't think God would have gave him heinous things, but he could ask for anything, money, love, whatever he wanted. And the only thing he asked for wisdom.
Yeah.
Which wisdom, and I talked about this with Cody as well, and wisdom to me is, and we've talked about it, is not, you can be intelligent but not wise. So intelligence, you have an understanding of things, but wisdom is you have a deep, deep knowledge of everything, and you apply that deep knowledge to every aspect of your life.
Yeah.
And being wise. And what's funny is people are like, oh, I would have asked for all the money in the world. And you look at Solomon, he asked for wisdom. And just because he placed wisdom in his relationship with God here, everything else just seemed to follow. Because if you look at it inflation adjusted, he's the richest man that's ever lived.
Of all time. Yeah. Which is pretty amazing. And Solomon was a son of who?
David.
Yeah. He was a son of David. King David, one of the greatest kings of Israel. a man who God said was designed after his own heart.
Yeah.
Which is wild because King David screwed up
Yeah.
a bunch of
Actually,
things.
I'll read it to you. My great friend Eli sent me a text the
Shout
other
out
day.
to Eli.
Yeah, sent me a text the other day, and it's a prayer coming from David. So it goes back to taking accountability for yourself, and it ties in perfectly. So David said a prayer that said, "Oh Lord, do not rebuke me in young anger or discipline me in your wrath. I feel the weight of my failures pressing me down like arrows piercing my heart. My sins raise over my head, and the guilt is more than I can carry. It crushes me and leaves me weary."
Mm.
One sec. It's different when you read it in your head and then out loud.
That's what Scripture does too. It's called purifying the
says,
soul.
My sins raise over my head, and the guilt is more than I can carry. It crushes me and leaves me weary. Bowed down in sorrow, I walk through the day mourning, with no strength in my body and no peace in my spirit. But my heart is restless, my strength fails, and even the light in my eyes has grown dim. Those who once stood beside me keep the distance. Friends and loved ones stay away from my suffering, and I feel abandoned. Meanwhile, those who wish me harm draw near, whispering lies and plotting destruction. Yet I choose silence, refusing to answer them, for I know my hope is in you alone. I lift my eyes to you, Lord, trusting that you will hear me and not allow my enemies to triumph over me. I confess my sin and acknowledge my weakness. My sorrow never leaves me, and I'm overwhelmed by my own failings. Yet even as my adversaries go stronger and more numerous, and even as they repay evil for the good I try to do, I still cling to you. I plead with you, Lord, do not forsake me. Do not be far from me in this time of trouble. Hurry to my side and be my salvation, for only in you can I find the rescue, strength, and mercy my soul so desperately needs. Amen.
That's a tough one to get through, huh? Because in self-reflection, we all, in some period of time, probably felt that in some extreme.
Mm-hmm.
So that's really, really beautiful that you are seeing this in a period in your life early on and seeing the redemptive fact of when you turn those things over to God.
Mm-hmm.
It doesn't make it magically just go away,
Mm-hmm.
but it does have the spiritual comfort of knowing that you have, and I'm going to use a churchy word here, the Redeemer,
Mm-hmm.
who makes straight the path
Mm-hmm.
and makes it ever clear
Yeah.
of, hey, this is a narrow path,
Mm-hmm.
but if you stay on it, there's a reward for it
Yeah.
here and the afterlife.
Mm-hmm.
So good on you, dude. That's awesome. Yeah, I mean, so the podcast today is really supposed to be about finance
Yeah.
and about, your world of investing, saving, legacy building. But what we just talked about there is legacy, a spiritual legacy, and what you set in motion today,
Mm-hmm.
how you behave today sets the course for the relationships and the results that you'll have in your lifetime.
I mean, yeah, just reading that, looking at what David was seeking after, and then for his son to grow up and say, "Oh, I want to be the wisest man to ever live."
Yeah.
I mean, that just goes to speak volumes of what David did as a king as well.
Yeah, that's so cool.
Mm-hmm.
Hey, if you're wondering what we're talking about here, you can go grab a Bible and read those stories yourself. But the other thing I would just encourage you with is go into a quiet place and pray to the Almighty God
Mm-hmm.
and His Son, Jesus. And if you don't believe that, that's okay. We love you anyway. So, slightly switching gears a little bit. Thanks for sharing that today.
Mm-hmm.
Be careful what you ask. When you ask someone how they doing and what's going on,
Mm-hmm.
be prepared for the answer, right? So thanks for sharing this.
Yeah.
That's super cool. So I was telling you earlier this morning, I had a conversation with a neighbor earlier this week who'd moved out of state and called me up and said, "Hey, Kenny, my wife and I are looking to do some estate planning, and we feel like we've kind of got things in order. We've got our investment set up. We've got our insurance set up." But he goes, I still feel a little confused.
Mm-hmm.
And he goes, I'm an educated guy. I fly airplanes for a living. I've got a strong educational background. My wife's in the medical field. But man, when it comes to my finances, he goes, there's things I just don't know the answers to.
Mm-hmm.
And, now that we're not like across the street from each other, it's not quite as awkward anymore. Can we have a conversation?
Yeah.
In jest, that's what he said to me, in jest. And I was like, sure. And I was like, well, people in our industry, Isaiah, especially in the investment world, I can't just pick on investments. In the insurance world too, on our side of the fence, we typically try to make things really complicated and sound really sexy and really cool. And we think we're impressing consumers when we do that. Mm-hmm. We're not. Mm-mm. We're just creating mass confusion. We're creating more distrust.
Longer meetings because you have to explain everything.
Longer meetings. Now, I'm guilty of having long meetings because I like to talk about this stuff, and I like to share, and I like to make sure that people walk out with an education.
Mm-hmm. Absolutely.
Which can sometimes make my meetings go long. So I'm guilty of that. So if you don't want a long meeting, don't meet with me. But a long meeting might be 90 minutes. But to that point, I think a lot of people today just want to hit an easy button and just have it done for them.
Yeah, that's what I get a lot is easy button. Put it wherever you think I'm going to get the most bang for my buck or biggest return.
And Isaiah, put it where you think. And then what happens when you think wrong or you get it wrong and things don't go well?
I'm getting chastised.
Yeah. So it's better to be integrated in a conversation where you come together as a team and you build a team process, team methodology. It's one of the things we try to do in our financial planning firm is to bring together the client with the advisor, investments with insurances, and all the things in between to create harmony and to create a plan that harmoniously works together in concert. And when I say in concert, think about that if you've ever been to a symphony and you've sat in an audience in awe and watched a conductor lead a symphony. All of them are experts, the violinist to the percussion to the cello and everything in between, the horns. But if there's no one conducting or bringing them together in perfect timing, perfect unity, it can be a little bit of a mess. I remember when your brother was in there was a homeschool program years ago, and he had just started playing guitar. Jake, I don't know if you remember this, but you were like and Jake's in the control room, so if it seems like I'm talking to someone, it's Jake in the control room.
Yeah, I remember exactly what you're talking about.
You were like in this praise and worship band, and you were on guitar, young girl on vocals, there was a drum and a bassist. And the first time you guys did a session in front of your classmates, it was
horrendous.
Yeah, it was abysmal was the word I thought of. And I felt so bad for you guys. And I was like, man, there needs to be someone who takes over this and really leads with the timing and leads with, pulling the band together. And usually that's called what? The MC, Jake?
MD, music director.
Music director. So that's the guy who's talking in the mic, and you're like, man, it doesn't look like he's singing the lyrics. Well, he's not, or she's not. They're usually talking through the timing of the song, right, Jake? Or different things that are going to be happening in a song?
Yeah, it depends on the context, but for the most part, yeah, it's a single person that's pushing the whole band and guiding the whole band in a common direction.
Yeah. So to that point, I'm having this conversation with our old neighbor, and he goes, Kenny, I don't really grasp the concepts of my money and how it works. And so, Isaiah, we were talking through this, and I said, well, without sounding elementary, do you mind if I just kind of break it down for you using a bucket analogy, and how our money has a flow through buckets? And the compliment I was given after this, it just made me think, maybe I just need to hop on a podcast and let's quiet the noise and just really keep money principles super simple.
Yeah. I mean, the bucket strategy, the way I look at it, is literally like you have 3 buckets right in your entry door when you're walking home from work, and you take out your pocket, you drop a little there, drop a little here, drop a little here, and keep walking. It's really that simple when you break it down like this.
Yeah. So I'm going to do that for you today. I'm going to put it on the screen for you. I am not an artist, in full disclosure. This is probably going to look really choppy, but I'm going to do it anyway. And we're just going to talk through these buckets for a few minutes. And these buckets, whether you use a bucket analogy, silos, boxes, circles, what I'm simply going to show you is the flow of money in our economic system. And our economic system is built around dollars.
Yep.
And the flow of dollars through an economic system. Our dollars, to be fancy for a minute, are based on what's called a fiat currency, F-I-A-T. That's a French word that, in short, basically makes it fake.
Yep.
Right? It's not backed
by anything. It holds its value because we said it had value.
That's right. So it's backed by the full faith and credit
The U.S. government.
of the U.S. government. Most economic systems today are backed that way. Some countries now have what's called sovereign wealth funds, which help support their economy. Saudi Arabia comes to mind.
They got all that
Norway
oil.
comes to mind, another big oil country.
Yep.
And our current administration, President Trump, has thrown out the idea, and I think he'll probably continue to press forward with this with his economic advisory board, where the U.S. might actually end up in a sovereign wealth fund for our country before he leaves office. Yeah. Now, whether he gets it done or not, if he can do that in 3 more years, that's pretty amazing.
It's not as similar as being backed by gold, like we were on the gold standard before we went to a fiat currency, but it is similar.
Because it's asset backed. It's lots of different, from cryptocurrencies to gold, to our country's oil reserves, to our land. And so right now, that's what the credit of our country is based off of. And the country goes, well, look, we got all this land, we got all of these assets, we've got all of these taxpayers, and we help push the credit worthiness of our country forward for other countries to invest in us, buying our what? Buying our debt.
Yep.
And the debt is called bonds.
Yep.
And so we can get into a whole economics course one day.
Yeah, but I think if we just break it down where money goes, it starts with 2 things.
Yeah.
Your money can either be taxed or not.
Yeah. Well, I actually take it into 3 buckets, Isaiah.
Yep.
So, Jacob, are we going to have this on the screen now? There we go.
Yep.
Blank piece of paper.
Well, I said it's taxed or not, and then after these 2, it falls down to 3 buckets where you could have your money.
Yeah. Well, I'm going to do it this way.
Let me see.
All right. So here's bucket number 1, bucket number 2, and then bucket number 3. And then we have money flows. So money flows into one of these 3 buckets. Most of the time when we're W-2 wage earners, the first bucket that money has to flow through is a taxable bucket.
Mhm.
So if you get a W-2 income, it's going to flow into this taxable bucket.
Yep.
And these other buckets to the right of taxable are places that we can put our money after it flows through that tax bucket. Now, if you're a business owner, that taxable bucket's still there, but you get to control how the money flows through that bucket. As a business owner, you have things called distributions or draws, and those can legally avoid certain types of tax, the big one being self-employment tax. But the Internal Revenue Service says, well, you have to take a reasonable wage, and that reasonable wage, if you're going to do it the right way where you can defend it, you should do what's called a reasonable compensation study. And that will help you defend why you take the salary you take in your organization.
Yeah, especially if you're like a sole owner, you're the only one doing it because you're the
Yep.
you're the CEO, but you're also the janitor, the cook, the
Chief
cleaner.
bottle washer,
Yep.
right? So in a subchapter S, you definitely should do a reasonable compensation study. And if your accountant hasn't had you do one, reach out to us. We'll show you how to do it. We can actually help you, provide you with that. And you can do it on a DIY basis, or you can have a professional help you. Either's okay as long as it's my friend Tom Wheelwright, who's a CPA, to Robert Kiyosaki. Robert Kiyosaki, arguably one of the greatest real estate investors of all time, wrote the book Rich Dad, Poor Dad, and multiple other books that we'll actually put those, Jake. Let's put Rich Dad, Poor Dad in the link, and let's make sure people read that. If you are thinking about real estate, Robert Kiyosaki is a great educator on that system. So this concept here of these buckets is that money flows, and money flows first in a taxable bucket.
Yep.
The next place that you can put money is in a tax deferred bucket. Now, tax deferred insinuates what, Isaiah?
Postponing.
Postponing. So you hear the sexy word defer,
Deferral.
but deferral also means that you're not doing it right now. So we're not taxing it today.
You're pushing it to an unknown bracket.
That's right. So in the future, we don't know what income taxes are going to be. And in financial planning, I can get really concise and tell you factually what's going to happen today. But the further I move away from this little circle here, and I get further out, I can't tell you what's going to happen the further out we get. It's more of a guess.
Yep.
So when we're thinking about your money and we're thinking about tax deferral, that's one of the things you need to consider is if you put money in a tax deferred bucket, you need to think about your future. So if you're a young person, if you're Isaiah's age in your late 20s, and you're really just starting to enter the workforce and your income, let's say the table represents zero. Zero. You have zero income as a young person.
Yep.
You're usually borrowing somebody else's dream. You're borrowing someone else's income. And as you start to identify with the world that you want to be part of and that you want to change, AKA the way you worship, the way you live, the way you work, and that work translates into wages for most people, you start climbing up the table. You start getting to the top and above. Now, in your early years, it's logical for most people that you start in the early years with lower income. So if you think of that in stages, the first 10 years of your working life, you probably made less money than you did in the second decade of your working life. So if you're deferring the tax at the time you're at the lower bracket, and then you defer it to that second phase of working life,
You're deferring it to a higher bracket.
there's the potential that you're deferring it to a higher bracket, which is why the government in the 1990s came out with an alternative to tax deferral.
Senator Roth.
Senator Roth of Colorado created the first Roth IRA, which created a truly tax-free bucket. Now, there's some of you out there who are going to go, Kenny, there's always been a tax-free bucket. It's called muni bonds. Well, municipal bonds aren't necessarily tax-free. Holy cow, Cody Hines decided to come to work today.
Oh, my God.
Good to see you, Cody. He's behind the camera. If you didn't want Cody, step in. We can show them what a late worker looks like.
Yeah.
Late to work.
And a short sleeve collared shirt.
They can't see. This is Cody. This is what late looks like.
Yeah. Short sleeve collared shirt.
Nah, I'm kidding. Cody told me this morning he actually works like 15 different jobs. And he had to go to his other job this morning. But we're glad you're here because we're going to do some other stuff in a few minutes, right?
Yeah, we could have seen him better too if you let him just fix the camera before you
Yeah.
interrupt it.
Did he not fix it? With my eyes
Nah.
situation, everything looks blurry.
Not yet,
you
but
look
we
at-
can keep going.
Yeah, if
We're
you
good.
look at Cody's, if you look at Cody's outfit, he just got
Hey,
back from Heron Ridge.
Cody,
playing golf.
and I almost committed the unpardonable sin. We didn't do a toast today. So I need to do a toast. Isaiah's drinking water because he's on a sabbatical for alcohol. That's what I've been told. Didn't you
mean-
tell me that? Oh, I thought you said you weren't
I
drinking.
had
Right.
beer last night.
You did? Okay. Could you do us a favor and pour some 4 branches? Thank you.
I'm not out here I'm not partying.
Okay. All right. Good. Sorry, that was a little sideshow, guys. This is live. We don't cut it. We don't edit it. Maybe they do a little bit now, but not much. So, tax-free. So this tax-free bucket, Senator Roth of Colorado introduced legislation to create this bucket here, tax-free. Now, I was saying muni bonds was an area where we could be federally income tax-free, but it does not avoid state income tax. And what's interesting is that muni bonds can actually make your other forms of income taxed higher
Like Social Security.
because that makes your Social Security rate go up under our current tax code as of 2025. Thank you, sir. It also affects other income. So if you have capital gains from other assets, wages, royalties, whatever, it can make those taxed at a higher bracket. So you have to be careful calling that truly tax-free because it doesn't avoid all taxes the way Roths do. Now, there's one other place in the tax code besides Roth 401k, Roth IRAs. So I'll go ahead and put this on the screen here for you. So this would be 401k Roth, and then IRA Roth. So those two places, you can put money on an after-tax basis into these accounts. They grow tax-free. And then when you go to take them out in the future after 59 and a half, and there's some other little nuanced rules there. We're not going to get into that today. But after 59 and a half, both your contributions and your growth, whatever it grew to, comes out income tax-free, avoiding Social Security tax, FICA or Medicare, income tax, state income tax, completely income tax-free, and it does not raise your AGI or your max AGI. It totally avoids income tax. Now, there's only one other place in the tax code that has the capability to do that. Those are called and been referred to as LIRPs, life insurance retirement plans. So life insurance retirement plans is simply a life insurance product that grows tax deferred, and you pay for it with after-tax dollars. So you pay the premium with after-tax dollars, and then you have the access to get your basis and your growth out income tax free if you follow two rules. And it's completely income tax free, just like your Roth. But those two rules simply say that you can take your basis out and not pay any income tax on it. If you want to get the growth out, you have to take that out in the form of policy loans. And there's a lot of people out there who are misinformed, who get pitched this product in a way that's
The be your own bank.
not completely accurate. Now the BYOB folks that are, what's the word I'm looking for? Apostles or folks who are really promoting that system. There are actually some really good people there and some people who use that system really, really well, and they're really good at it. But there's the wannabes out there that I would say give it a bad name, and who do not follow that system well, and it can be a black eye for the industry. But you want to make sure if you're going to use that product that way, you need to understand the asterisk. I tried to draw an asterisk there. What are the gotchas? What are the catches? And every one of these buckets should have an asterisk beside it, because there should be a little disclaimer that says that not in all cases will this be the case. Because there's nuances to every plan and every bucket. But here's why I share this. These are the only three places in our economy, in the American economy, and actually any global economy that I'm aware of on this planet, there's three buckets for money to flow through. Now, not every country, I think, has a Roth or the equivalent of a Roth. So it might be two buckets for other people outside of the United States. But dealing with our client base and the folks that we can help here in the U.S., we're talking about three buckets and three buckets only: taxable, tax deferred, tax free. Your money flows in one of those three buckets and those three buckets only. They can flow this way, they can flow that way, they can flow over here, and it can actually flow back. And it's important for you to understand how those buckets work in concert together. You can have too much of a good thing. What Isaiah and I are hearing a lot today is a lot of pre-retirees turning into retirees. The first question they come to us is, Kenny, I want to put money in my Roth. I want to do a Roth conversion. And when they do a Roth conversion, it means they're converting the tax-deferred account to a tax-free account. But what happens many times is that a person can have too much of a good thing. Like a little shot of bourbon ain't going to hurt us today. But a little shot of bourbon now, an hour from now, another hour from now, on a consistent basis can ruin your life. So can trying to put too much money too fast into your Roth or doing a Roth conversion. So we need to look at that from an economic science point of view. We need to look at that in a test tube to see how we can do a Roth conversion and not vault you into an unnecessarily higher bracket. Any thoughts?
Not really. I think you're hitting most of it right now. My thoughts on it too is just when you're in the retirement distribution phase, how to effectively use all three of these buckets simultaneously. Like you said, you can't always take tax deferred, turn it tax free, because you could end up vaulting yourself or bracket bumping yourself. And that's something we go over in our workshops quite often. But knowing how to understand in the first bucket, that taxable bucket, kind of flows into your non-qualified accounts, and understanding how to structure distributions from all three of those types of accounts and how it can work for you to get income. Income is the outcome at the end of the day. So knowing and understanding how capital gains work, knowing how tax-deferred buckets work, and how these tax-free buckets can work.
Good point. Now, we talked about pre-retiree, retiree. For young people out there who are just getting started, if you're just getting started, the place that we would say, hey, look first to try to maximize
Your Roth.
is the Roth. And here's our stance. Here's our religion on this. Our religion is that we believe that in our society, unless government changes the rules in the near future, the only place we have in our society for income taxes to go in the future is up.
Yeah, and that brings up a great point even that we go over in our workshops is I love how this slide correlates with everything else. The first slide talks about U.S. national debt levels, and then the next slide is RMDs, and then it goes in to tax-deferred accounts, which I think works very well together because if you look at the overall plan, so if you have you look at national debt levels and then you see that it's rising year over year over year over year, it really forces the U.S. government to look at doing one of two things, and that's cut government spending, which if they cut government spending, they could cut, so like a lot of rhetoric in the marketplace that people were scared of 6 months ago where, oh, am I going to lose Social Security? Am I going to lose, what's going to happen with Medicare and Medicaid and all these government
Back programs.
What's going to happen with that? And then the next thing they can do is raise income tax on its citizens. And I think as we move forward, if government doesn't get spending under control, I think we could see a little bit of both. Not doing away with Social Security or anything like that. I think we talk about it pretty often about how in my demographic, the 20-year-olds, the 20s right now, will probably see our Social Security minimum age get pushed to the right.
Yeah.
I agree with that. I think that's what we'll see. And really trying to build back this Social Security trust fund, if you want to call it, because it's set to run out by 2032. And that's solely because modern medicine's getting better. People are living longer. And so when they look at these mortality tables for older people when they go draw Social Security, they're living longer, so they're taking more money out of the pot. And you see it start to decline a little bit. So I think going over this and preparing for planning and moving forward and being able to structure a plan that deals with, okay, what happens if I have money in this tax-deferred bucket and we see tax rates go up back to like 1943 rates or 1942 rates.
So I have an industry acquaintance that many of you out there have probably heard of. Jacob, do me a favor, and I want to expand on what Isaiah is talking about here. Go to Google and put in Power of Zero movie trailer. And so, folks, this is a documentary created by a guy named David McKnight a few years ago, and it was a brilliantly done movie. I want you to watch this trailer real quick. Jake, if you can bring it up on the big screen where Isaiah and I can watch it.
Instead of paying for all the new initiatives, whether they're tax cuts, spending increases, all sorts of things that we like, the government's just putting it all on the national credit card. And as a result, our national debt is just going up and up and up. And it's growing faster than the economy, and that's when you know you have a real problem.
Everything is going to be squeezed out of the budget. There won't be anything left.
The road we're on is a perilous one that ultimately leads to the bankrupting of our country.
So we have a crisis on our hands.
All Congress has to do for this whole situation to come to a head is nothing. Because every year that they do nothing makes the problem even more unsolvable.
We don't seem to have the ability to get along and find common ground.
Is the government trying to trick you right now? And the answer is very simply yes.
So why is this being swept under the rug? Why is nobody talking about this?
Probably because it's not popular.
So I've actually been traveling around the country for about 4 years now, taking the Power of Zero message to different groups.
When you cut taxes on current generations, you are simultaneously raising them on future generations.
It is all driven by spending. Once we have spent a dollar, we've already decided to tax it. The only question is whether we tax it now or we borrow it now and tax it in the future.
So to make up for the liabilities that we're incurring with all the promises we've made in social insurance programs, we're going to have to increase substantially the tax rate and perhaps even double it.
Now, precisely how high it's going to be, there's a lot of room to debate, but people will have to pay more taxes.
People's retirement savings are at risk of future higher taxes.
Well, qualified plans really do two things. They defer the tax and the tax calculation. Now let that run past your brain real slow.
I'm driven by trying to help as many people as I can avoid this disaster that's going to come up in retirement when taxes go up and the market goes down. What are these people going to do if they haven't planned ahead of time?
And you look at one of the persons that are the person that comes up first in the trailer is a guy named David Walker.
Yeah.
He was the head of government accountability from 1998 to 2008. And on his way out told Congress that we had a fiscal cancer, which was our government spending. Yeah. So I don't know when this movie was made or put out to the public, but back in 2008, David Walker was saying the same things. He even wrote a book called Come Back America we've talked about before, talking about the things that the government has to do in order to avoid or try to deter kind of almost a fiscal collapse.
Yeah. Well, he said there were two things, Isaiah. He said this to Congress in 2008, right before he retired. He said, America has a fiscal cancer, and I'm going to try to quote it verbatim, and I know I won't get it right, but very close. America has a fiscal cancer, and we have two things we can do to cure it today. Mm-hmm. He said, number one, we need to cut federal spending by 50%. Mm-hmm. Now, he said this in 2008, and the federal deficit in 2008 was not $37 trillion and counting. Mm-hmm. As a matter of fact, I think it was maybe approaching, fact check me on this, I'm going to tell you what I think it was. I think it was around 19 trillion.
Yeah, I think it was like I actually think it was like 13 trillion.
In 2008. What was our federal deficit in 2008? I
think it was like 14 trillion.
You can put it up on the screen, guys. Fact check me on this. The federal deficit in 2008, when David Walker spoke to Congress.
And then they do a crazy calculation called fiscal gap accounting.
Can you put it up on the screen here where we can see it?
455 billion.
The deficit 2000 was no, that was for that year.
Yeah.
What was the?
I would say that's too low.
What was the federal?
That's what it was back in like the 1980s.
Yeah. The federal deficit, not for 2008, but the total. Yeah. Keep going. Bring that down. Yeah, they're just talking about 2008.
So while he's looking for that, if you look at this thing called fiscal gap accounting.
That's Dr. Kotlikoff.
Yeah, so fiscal gap accounting, they're talking about, so they look at the debt of what it is right now with present liabilities on our balance sheet. So if you take total expenditures, debt, 9.9 trillion. There it is. Right there, 9.9.
Go to the USDebtClock.org.
And if you do fiscal gap accounting, this is taking in future liabilities that the United States has not paid for yet.
Yeah.
And they're saying that's upwards of our actual debt being around 100 trillion.
There we go. Go to the time machine and go back. Click that back button.
It's not letting me.
Oh, it's not letting you do it. What was it in? There is a way to go back and look at it. I don't want to bog down on it. But let's just look at the number now. 37 trillion and counting. By the end of this year, we're going to be over $38 trillion as our federal debt. And David Walker said to Congress in 2008, whatever the number was in 2008, I want to say it was over 10 trillion.
I'm going to the thing that's going to take over the world one day, ChatGPT.
Yeah, that article that I pulled up on Wikipedia said by the end of the fiscal year it was like 9.8 million.
Here's the breakdown. At the end of fiscal year 2008, September 30th, 2008, the gross federal debt stood at 10 trillion.
10 trillion. So I was off by 4 trillion.
I said 4.
So Folks, we're now 17 years later at 38 trillion, almost 38, 37.5.
That was 68% of U.S. GDP at the time.
Yeah, and now we're at over 100%. Of GDP.
214%.
Wild. So Walker says to Congress, you need to cut spending by 50%, and income tax rates need to increase by 50%. And he said, if we don't do this now, by the time we get to 2035, he said, we're going to have to see income tax rates back in the 90s, which is where we were in 1944. And you're going to have to cut spending. You're going to have to do both of those. So in 2008, I want to correct myself. He said, cut spending by 50% or raise income tax rates by 150%. And so which do you think the government's more likely to do?
Oh, they're going to raise income tax rates by 150% and then raise spending another.
Yeah, and then he said to them, you don't do either of these by 2034, 2035. You're going to have to do both. So thanks for putting that up there, guys. When we look at this tax deferred bucket that I drew here, that tax deferred bucket for 20-somethings, it shouldn't even be an option. If you really want to secure your money in the future, a taxable bucket and a tax-free bucket is all you should focus on trying to have. Now, there will be occasions in the future that if income tax rates do come down, you'll want to have that tax-deferred bucket again. But for what we know to be true now, and the rules that we're playing under right now, my suggestion to you is to consider only having a taxable bucket and a tax-free bucket. Now, there will be occasions where, like your employer, under their employer plan, can only put money into the tax-deferred bucket with their matching dollars.
They're working on being able to contribute to the Roth.
Actually, under the new tax rule, the big, beautiful bill, and even before that, the provision to do a employer match into your Roth is on the table. It's just we got to get custodians, the people who manage or hold the money, not manage the money, but hold the money, the Charles Schwabs, the Fidelities, the Empowers, the Guidelines. They need to catch up to the rules changing. Mm-hmm. And that's the government for you, though. The rules change a lot and often. Mm-hmm. But when we're looking at these buckets and how they work together, it's important to know the sequence of how you should move that money. So more than likely, your W-2 wages and other income, those are going to flow into your taxable bucket first. You can avoid that tax by going here first. But again, if you avoid it by deferral, like your 401k, if you put $30,000 in your 401k, yes, you're avoiding the taxes today, but you're postponing to tomorrow. So when you postpone until tomorrow, what are you postponing to? That's the magic question you have to answer for you. Mm-hmm. And it's not what your neighbors do. Mm-hmm. It's not what your mom or dad has done. It's all on you. It's the question you have to answer for yourself. And the best way to do that is to do a future analysis of yourself. It's to look at yourself at 40 years old. Look at yourself at 60 years old. Apply some principles of time value of money, mm-hmm. and put it in a tax-deferred bucket, hypothetically. Put it in a tax-free bucket, hypothetically, after tax. So if you make this contribution to the tax-free bucket, you're going to do that on an after-tax basis. So that's where a lot of proponents of tax-deferred will say, Well, I've got more money compounding because I've got the government's money compounding before tax in my account for me. True. That is absolutely true. The only difference is, why would the government give you anything when they are starving for revenue? If they're going to give you that money to compound, who do you think they're compounding it for?
Themselves.
And if you do a really good job, who else is doing a good job?
The government.
They get it. Today, I would tell you they would rather have it today. But they're okay waiting because they're waiting at interest.
Mm-hmm.
They're waiting with the compounding of knowing what the future asset's going to be here. And the government says, hey, we're going to be around here forever anyway. We're not going anywhere. Governments are like casinos. They have unlimited resources, and they have unlimited time. You and I have limited time and limited resources. So we have to understand what's in our best interest. It's kind of like, Isaiah, when you're building portfolios for clients and you're doing this risk profile, and sometimes the statements are, hey, Isaiah, I want to get stock market returns. And they come armed with information that says, well, the 100-year average on the stock market, the S&P 500, has been over 11%. I should be able to get 11% every year. Well, that's not how averages work.
Nope.
If the average was 11 over 100 years, that means there were some periods
that were negative.
50% were greater than 11, theoretically, mathematically. 50% were less than 11. So if you're thinking about that in the distribution phase, which period of time are you going to be in when the market's negative or positive?
Yep, and that's what I was explaining to a client that came in yesterday is when you start looking at retirement income planning and you break it in tranches, so you hear this 100-year average is 11 point, or the average of the total return of the market is 11.1%, and then you have these down periods. Really, the timing and structure of when you take money out of these accounts really matters, because if you look at a 10-year period, so the first 3 years of your retirement are the most pivotal, especially if you have all your eggs in the market. If all your eggs are in the market and you see down period, down period, down period, that's going to impact your future and your income forever. Just because those negative years in a row play a huge part of how successful your retirement's going to be. So that's why it's always important to diversify not only in the market, but diversify asset location of where your assets are held.
Asset location, how they're titled, because what you're referring to is our industry, we refer to it as the sequence of returns risk. So that risk in and of itself, the timing of when you retire and what happens in the market matters to the longevity of your investments.
Yeah, I mean, if you look at the last decade, the market did 1.9% positive net, and you look at that and you're like, oh wow, that's not. I mean, I still got 1.9% of my money, but if you retire in that year and you're taking 4 to 5% out of your account, you're not up 1.9%.
You're down multiple percent.
Yeah. You're down.
Yeah.
So it is, because you gotta look at what's the compounding outlook of, okay, in 2008 I had to take a 4% drawdown, but I also lost 37%.
Yep.
Or then 2007 and 2009 I lost 52% of my portfolio and had to take 4% out each year. So between those 2 years you took 8%. So really you're down 60.
Yep.
So it's important to know where your assets are held and what they're held in and what they're doing.
Great points. So these flows here, as we wrap up today, and you look at your money flows, this is the start. Is it taxable? Is it tax deferred? Is it tax free? And then those dollars are going to flow into other buckets. And when we're creating plans and designs for our clients, we have to bring together what we call actuarial science with investments, which means there's basically 3 buckets that those dollars are going to flow into. This bucket over here we'll call growth. I should say growth and legacy. because growth and legacy means that we've got money that flows here, sets here. This is the opportunity bucket. This is the bucket that's going to grow and move, and it will shift money back over to this bucket, which is your income or protected income bucket. This bucket should protect the cash flow that gets moved into your income bucket or cash flow bucket. And those cash flows are the dollars that you use day in and day out to live your standard of living. So as we're using these dollars, money can move back and forth between these buckets, and they can work harmoniously together, but they're going to flow first through the tax buckets, kind of the tax silo, tax filters, and flow down into income and cash flow, guaranteed incomes and protection of that income, and then growth. And so we can then drill that into, well, there's really only 27 places that money can go. And I've been using this model for my clients for going on 3 decades now. I've taught my son this model, and I've taught many people in our business how to use these models. And this is really bad drawing here. But these models are made up of sub-models or sub-components that basically give us the ability to put money in protection, savings, and growth, or what we refer to as the PS&G model. And these models that we've created for our clients over the years, it doesn't matter if you're Donald Trump, Kenny Porter, Isaiah Porter, or any person in between, Elon Musk. There are only 27 places that money can go. And if you would like to know more about those 27 places, stay tuned. We're going to talk about that more in future podcasts. Or you can reach out to us by subscribing, liking, messaging us, and we will have a personal one-on-one conversation with you, free of charge.
Yep.
No obligation to have a conversation. You can never get a second opinion from that first person that gave it to you. So if you'd like to hear more about how we do this, how we work with our clients, our money models, we'd love to have a conversation with you. Thanks for listening to us today. Thanks for tuning in. Before we go, we've got a shot here on the table, and I did this backwards from what I normally do.
Mm-hmm.
Hey, Cody, can you help me out again 1 second here? Can you grab the 4 branches sign for me? We've got a buddy, Harold Underdown, who's been a 20-year-plus friend of mine. He came on the show back in the summer of 25, this summer, and he picked out his company's bourbon in a blind taste test. And I said, Harold, if you can do that, we're actually going to drink your bourbon for a year. And we're going to toast in every Blackbox podcast. We're going to toast our veterans who are super port nuts. Here in our firm at Kenneth Porter and Company, I would say over half of our client base had some military service. I'm a prior Marine, the greatest military fraternity in the world. Second to that might be the Army. Isaiah was with the 101st Airborne in the Army. My buddy Harold was a Navy SEAL, U.S. Navy. My father-in-law was in the Air Force. My other father-in-law, which is complicated, we'll talk about that another day, who was on the podcast. Shout out to Mark Olson, Grandpa Mark, and Grandpa Wayne was on the podcast. Mm-hmm. Grandpa Mark, Navy. Grandpa Wayne, Air Force, Thud fighter pilot in Vietnam. Mark was a physician in the Navy. So all of that to say, we honor our veterans. We honor those who are still serving today, the families who are serving, our Gold Star families. You guys mean so much to us, and we want to throw a toast to say thank you, as we always have and always will do that. So, Isaiah, you doing it with water, or are you doing it with... There you go. Cheers to you. Go get you some Four Branches bourbon. You'll be glad you did. Peace.
Blackbox.